Welcome to the deep dive.
Great to be here.
Yeah, so today we're cracking open the brand new McKinsey Global Private Markets Report 2025.
Hot off the presses, right? Just out last month.
Exactly. And it gives us this, panoramic view of how private markets navigated some really, mixed conditions in 2024. Expert, I was immediately struck by that opening paradox. Deal making was kind of tepid, fundraising hit lows not seen since 2016.
Yeah.
Yet public markets actually saw increased performance. What was your initial reaction?
It's a fascinating setup, isn't it? My first thought was how much the report highlights a sector not just surviving, but like actively adapting.
Right.
What's truly insightful is that despite those challenges, we saw a double-digit increase in capital deployment. It indicates, a fundamental belief in the long-term potential of these markets. Managers weren't just riding out the storm. They were structurally adjusting to, higher interest rates.
And the big takeaway for you, our listener, is that investor confidence didn't really waver. Leading limited partners, the LPs, are actually planning to allocate more capital, not less, to private markets in the coming year.
That's a key point.
So our mission today is to distill the most important nuggets of knowledge from this comprehensive deep dive. We'll look at how different asset classes fared, and then we'll drill down into 3 pressing issues that are actively reshaping the entire private markets landscape.
Yeah, the cross-cutting themes.
Exactly. You'll walk away with a much clearer picture of what's happening, why it profoundly matters, and, what to keep a keen eye on. Okay, let's unpack this.
What's truly compelling here is the sheer resilience shown by, all stakeholders.
Yeah.
It wasn't just about weathering volatility. It was about fundamental innovation. For instance, fundraisers looked beyond traditional closed-end channels
Okay.
and began exploring new, more flexible vehicles like evergreen funds.
Yes.
Meanwhile, deal makers pivoted from what was, for a decade, often just pure financial engineering
Yeah, leverage.
to a much more sustained focus on operational transformation within their portfolio companies.
Yeah.
That's a significant shift in value creation.
And the LPs themselves, they weren't just passively allocating capital anymore, were they?
Not at all.
They actually evolved to investing directly in the general partners or GPs themselves.
Right. We've seen this play out vividly in the thriving secondaries and GP stakes markets.
It's a testament to how active and involved LPs are becoming.
Definitely.
Of course, the report also notes some critical challenges on the horizon. Persistent geopolitical instability, evolving trade policies.
Already the factors.
And the rapid advancement of generative AI, which is compelling leaders across the board to build entirely new capabilities.
Precisely. These are foundational shifts influencing every corner of the market.
So to give you a clearer picture, let's start with a kind of weather report for each major private asset class, kicking off with private equity or PE.
Okay, PE, where the action often is.
Private equity. The report vividly describes how the rapid run-up in global interest rates, over 500 basis points in the U.S. from 2022 to 2023, literally shook PE to the core.
It really did.
After a decade of cheap leverage, that was a seismic shift, wasn't it?
Yeah.
What does it tell us about the asset class's ability to absorb such a shock?
It tells us PE is surfacing more resilient and durable than before. I mean, the enduring confidence of LPs is quite telling. 30% of them plan to increase their PE allocations in the next 12 months.
30%, okay.
This continued appeal is rooted in PE's historical outperformance of the S&P 500 since, the turn of the millennium.
Right, the long-term view.
It consistently rewards investors who can stomach the relatively lower liquidity and play the long game.
Here's where it gets really interesting on the deal-making front. Global PE deal-making rebounded significantly, up 14% to $2 trillion in 2024.
A big jump.
Making it the 3rd most active year on record. And bigger is back, as they say. Large buyout transactions over $500 million rose a staggering 37% in value.
Wow, 37%.
Technology continued to outperform in terms of deal value, hitting its 3rd highest on record, while healthcare, post-COVID, actually saw a bit of a retreat.
A pullback there, yeah.
We also saw public-to-private, or P2P, deals, where a PE firm takes a public company private account for 11% of total global PE deal value in 2024. That's up from 9% in 2023.
And Europe really stood out there.
Yeah, Europe specifically saw a 65% year-over-year increase in value for these P2P transactions. Huge jump.
Exits are also warming up, according to the report. PE-backed exit value was up 7.6% to $813 billion.
Still strong numbers.
The third highest on record. And what's particularly promising is that for the first time since 2020, the average holding period actually decreased.
Ah, that's a good sign for liquidity.
It's a vital sign for improving liquidity in, capital recycling within the market.
However, fundraising still faced headwinds. It declined for the third consecutive year in 2024, down 24% overall.
Yeah, that's a consistent theme.
Funds are also taking a record 21.9 months to close, compared to, 14.1 months back in 2018?
Much longer slog.
The only category that remained flat year over year was mid-market funds, those between $1 billion to $5 billion. That extended fundraising period must be a real challenge for GPs, wouldn't you say?
Absolutely. And these fundraising headwinds directly underscore a fundamental shift within PE, what the report calls the operator's imperative.
The operator's imperative, right.
Given increasing purchase prices and lengthening holding periods, there's a greater need for PE operators to focus intensely on value creation beyond just financial engineering.
Makes sense.
GPs are responding to this by increasingly involving portfolio operations teams.
Yeah.
The average team size has more than doubled in the past 3 years.
Doubled. Oh.
That tells you a lot about where the core value is being generated now. It's less about the entry multiple and more about what you actually build.
Okay, so from private equity's fascinating rebound, let's pivot to real estate. Another asset class that saw its own significant turnaround in 2024 after, a multi-year decline.
Yeah, RE had a tough couple of years.
The report indicates 2024 marked the first growth since 2021, with global real estate deal value growing 11%. We saw the strongest rebound in multifamily, up 20%, and industrial, up 16%.
Strong numbers there.
What were the key catalysts for this recovery?
Well, the recovery was largely driven by a less unfavorable financing environment as interest rates stabilized.
Right. Rates leveling off helped.
Yeah, leading to increased issuance of commercial mortgage-backed securities, CMBS, and critically reduced borrowing costs.
Right.
Supply also fell significantly. U.S. industrial construction starts down 32%. New multifamily construction down 41%.
Big drops in supply.
Simultaneously, cap rates compressed across multiple sectors, signaling stabilizing asset values. A compressed cap rate, for those unfamiliar, means the income return relative to the property's price is getting lower, often indicating rising or stabilizing values.
Okay. That said, rent growth moderated significantly in some key sectors. Multifamily went from 9.7% growth down to just 1.1%.
The big slowdown.
And industrial slowed to 2.1%. Data centers, however, continued to show immense strength, seeing strong rent gains at 12.7% in the U.S.
Data centers are just, a different beast right now.
This highlights a growing trend, doesn't it? That alternative sectors in real estate are becoming more, mainstream.
They're not just performing well, they are becoming foundational. The real takeaway isn't just that alternative real estate sectors are excelling. It's that they're becoming a more stable, often counter-cyclical bedrock for portfolio diversification, driven by, irreversible secular trends like digital transformation and shifting demographics.
Right, those long-term shifts.
What's also notable is how investors with strong operational capabilities are gaining market share. They accounted for 37% of real estate AUM in 2023.
37%.
An 11 percentage point increase over the past decade. These capabilities are becoming crucial for driving value beyond just cap rate compression. It's about active management.
A significant challenge, and also maybe a massive opportunity ahead, is what the report calls the looming wall of maturities.
Ah, yes, the wall.
Nearly $2.1 trillion of the $4.8 trillion in U.S. commercial real estate loans are set to mature within the next 3 years, particularly in office and multifamily.
Trillions.
For debt fund managers, this must be a golden opportunity.
It absolutely is. And while global closed-end real estate fundraising declined 28% to $104 billion, the lowest since 2012, ouch. LP interest in real estate debt is actually rising significantly. 63% of LPs express interest in real estate debt in 2025, up from 56% the prior year.
So the equity side fundraising is tough, but debt is attractive.
Exactly. It signals strong demand for alternative financing solutions as traditional debt becomes more expensive or unavailable.
Now let's talk about private debt, which proved to be a remarkably resilient asset class in 2024.
Very steady, yeah.
New issue financing for leveraged buyouts, or LBOs, increased 30% in the U.S. and Europe. What's behind that resilience?
Well, a key factor is its ability to step in where traditional banks might pull back. especially in uncertain times.
Right, filling the gap.
Interestingly, while direct lending still leads in LBO financing, its market share actually declined a bit as syndicated lenders increased their share, especially for larger deals.
Interesting dynamic.
We also saw spreads in direct lending compressed by about 150 basis points.
Spreads tightening.
And private debt managers are increasingly tapping insurers and other forms of permanent capital. Think business development companies, BDCs, and interval funds.
Right, those structures we mentioned.
Which offer limited liquidity but stable long-term capital. These sources are attractive because of their predictable cash flows and long duration.
And regulation plays a part, too.
Yeah, regulatory changes are also playing a role, driving some non-conforming assets off bank balance sheets, creating new opportunities for private debt funds.
Okay. Fundraising for private debt did decrease there by 22% to $166 billion globally. Mezzanine saw the steepest decline, over 80%.
Mezz took a big hit, yeah.
But what's really striking is the increasing fundraising concentration. The top 5 managers raised 38% of private debt funds in 2024.
38%.
Up from a 10-year average of 29%. What does this tell us about the competitive landscape there?
It really speaks to the competitive advantage of scale in this sector. Larger, more established managers with proven track records are kind of consolidating capital.
Makes sense. Bigger gets bigger.
And despite those overall fundraising declines, LP appetite for private debt remains exceptionally strong. 43% of surveyed LPs expect to increase their private debt target allocations over the next 12 months.
43%.
That's a higher share than for private equity or real estate.
Wow, higher than PE or RE. That's telling.
Performance-wise, private debt outperformed PE and real estate in 2024 and showed very low return dispersion.
Yeah.
Only a 4.7% difference between top and bottom quartiles, compared to like 15% for private
Not a greater range of outcomes.
Suggests superior risk management and more consistent return profile.
Okay, finally, let's look at infrastructure. Had a mixed year, but seems poised for clearer conditions.
Yeah, interesting picture there.
Fundraising was down 15%, hitting its lowest point in a decade.
Another dip in fundraising.
But capital deployment actually accelerated. Deal value increased 18%, making 2024 the second highest year on record.
So money going out faster even if less came in recently.
Exactly. Given the fundraising dip, what's driving the increased deployment?
What's fascinating here is that infrastructure garnered the highest LP interest for increased allocations in the next 12 months. 46% of respondents indicated this.
Almost half. Highest of all asset classes.
This bullish view is largely driven by massive secular trends. Think growing global trade. Nearly $33 trillion in 2024.
Huge numbers.
And of course, the energy transition. That alone could require approximately $6.5 trillion per year in new physical assets by 2050.
Wow, $6.5 trillion a year.
These are multi-decade tailwinds driving investment.
And it's not just about building new physical assets, is it?
No, managers are also increasingly focusing on active ownership, meticulously managing project timelines, addressing labor challenges, for example, boosting productivity through automation.
Operational focus again.
And the definition of an infrastructure asset is expanding beyond traditional hard assets.
Right.
To include service businesses with infrastructure-like attributes, like maintenance of data centers and telecom assets.
So the lines are blurring a bit there.
They are, and it reflects where the returns are potentially shifting. We're also seeing LPs increasingly seeking higher risk opportunities in infrastructure. Brownfield and greenfield projects accounted for 52% of infrastructure deals.
Over half.
The highest proportion on record. This indicates a shift towards pursuing more significant potential appreciation, moving beyond just stable core returns.
Interesting. Okay, now that we've surveyed the landscape for the individual asset classes, let's zoom in on 3 critical cross-cutting themes that are truly reshaping the private markets.
Yeah, the big picture shifts.
First up, the rise of novel AUM forms, or how alternative assets get more alternative.
I like that phrasing.
The report suggests that using traditional assets under management, or AUM, alone as a proxy for private market health may need some rethinking.
Yeah, AUM isn't the whole story anymore.
Because non-traditional capital now accounts for a rapidly growing share. What's the core insight here?
The core insight is that private markets are diversifying their very funding structure. We're seeing a proliferation of alternative sources of capital driven by, well, 3 main reasons.
Okay.
First, GPs and regulators are actively democratizing access to private markets for retail investors. That's a largely untapped $60 trillion pool.
60 trillion, wow.
We're seeing new vehicles and regulatory changes, like allowing U.S. 401k plans to invest in alternative funds and updates to the European long-term investment fund regulation. This opens up entirely new pools of capital.
Okay, so democratization is one. What's second?
Second, GPs are creating more customized solutions for large institutional investors. Think multi-billion-dollar joint ventures tailored for specific strategic goals, like energy transition,
Bespoke solutions.
allowing these LPs greater control and influence over their investments. And third, the private market universe itself is simply expanding. Over 17,000 active private market firms globally.
Just a bigger pond.
It's a vast and growing ecosystem. And this expansion is clearly visible in the numbers. The growth gap between traditional and non-traditional AUM is widening significantly.
How wide?
Non-traditional AUM grew an estimated 16 to 18% annually since 2020, compared to 10% for traditional. In 2024, this gap widened even further. Non-traditional grew 18–20% versus just 1% for traditional.
1% versus nearly 20. That's huge.
It's a fundamental reweighting of how capital flows into private markets.
And the report breaks down these key alternative capital types into three categories. First, higher liquidity products, representing $1 trillion to $1.5 trillion in AUM. These include evergreen funds, non-traded REITs, interval funds, non-traded BDCs, providing more frequent liquidity than traditional closed-end funds.
More ways for investors to get cash out, essentially. Second are LP demand-driven products, like separately managed accounts, or SMAs, at $1.5 trillion to $2 trillion AUM, and co-investments at over $2.5 trillion AUM.
Big numbers there, too.
These offer LPs greater control, bespoke exposure, direct influence, and often reduce their fee payments, too. They're tailor-made solutions.
And third is permanent capital.
Estimated at $1.5 trillion to $2 trillion AUM. Largely sourced from insurance companies.
Oh, the insurers.
GPs are increasingly acquiring or partnering with insurers to access these long-held assets for stable, long-duration capital that isn't subject to typical fund life cycles.
Okay, so with all these new forms of capital flooding in, what's the path forward for GPs in this evolving landscape?
Well, they need to fundamentally restructure and grow their fundraising teams to source from both mainstream and these increasingly vital alternative sources.
Makes sense. Broaden the net.
Crucially, they need to switch from a mere fundraising mindset to a solution mindset.
Solution mindset. Explain that.
It's about understanding an investor's unique needs, be it a retail investor looking for liquidity or an institutional one seeking a specific thematic exposure and then offering truly tailored products. This shift from product push to solution pull is critical for success.
That's a profound shift. Okay, let's move to our second cross-cutting theme, private equity's path to clearing the historic exit backlog.
The logjam.
This is a big one, because if funds can't exit, they can't return capital to LPs, and that creates a real bottleneck.
It certainly does. The challenge is stark. PE sponsors hold more companies, valued higher and for longer. In 2024, more than 18,000 companies had been under PE ownership for over 4 years.
18,000.
That's more than 6 times the number in 2005.
Wow, 6 times. And this really matters for several reasons, right?
Absolutely.
Delays in selling make fundraising challenging for GPs, as LPs are increasingly withholding new commitments until they receive distributions.
Show me the money, basically.
Yeah. Distributed to paid-in capital, or DPI, is now a critical performance metric for 21% of LPs, up from just 8% 3 years ago.
Big jump in focus there.
DPI essentially measures the cash LPs have actually received back relative to what they've invested, real liquidity. And extended holding periods can also jeopardize returns, especially given that entry multiples have nearly doubled in the past 15 years.
Right. You paid more going in, you need a good exit.
That's a lot of pressure on the exit.
A key factor explaining these exit challenges is a persistent mismatch between buyer and seller price expectations. Near-maturity assets often held at valuations higher than prevailing market prices.
The bid-ask spread.
Exactly. To clear this backlog, the report suggests a comprehensive exit playbook. The real insight is that PE is shifting from a buy and hold, then figure it out model,
the old way,
to a sophisticated engineer-to-exit approach. GPs need to start thinking about the exit even before acquiring an asset, building it into every stage of the investment life cycle.
Plan the exit from day one.
Yeah. And beyond the initial post-close value creation plan, or VCP, mid-cycle VCPs are emerging as best practice
Mid-cycle VCPs.
to unlock a second S-curve of performance improvement, aligning with what the next owner values, thinking ahead.
And the exit strategy needs to be carefully tailored for different channels, right? Not one size fits all.
Absolutely. For a strategic or corporate buyer, you identify potential buyers early, focus value creation on synergistic business units.
Okay.
For sponsor-to-sponsor deals, you need to communicate the uncaptured value creation potential, frame the asset story to align with the growth playbook for that next PE owner.
Tell the right story for the next buyer.
And for an IPO? Well, GPs must demonstrate a consistent track record of organic growth, have a clear and simple equity story, and, crucially, upskill the senior team to handle being public.
Lots of prep for an IPO.
Ultimately, flexibility is key. GPs must remain agile, not making decisions that might inadvertently preclude unanticipated exit avenues that could provide greater value. Keep options open.
Makes sense. Our final cross-cutting theme brings us to secondaries and GP stakes, which the report calls the next wave of private market innovation.
Really interesting developments here.
These two strategies are truly emerging to solve crucial challenges around liquidity and capital sourcing in private markets. What makes secondaries in particular so vital right now?
Well, secondaries continue to sustain upward momentum because they provide a vital liquidity channel. It's simple. They allow LPs to sell fund stakes early and rebalance portfolios.
Which is critical in an illiquid market.
Exactly. And for GPs, they also help retain control of assets not yet ready for a full exit, maybe through continuation vehicles.
Ah, the continuation funds, moving assets between funds.
Right. Where an asset moves from one fund to another, often with new investors coming in.
And the activity is booming. Total secondaries deal volume surged 45% year-over-year to $162 billion in 2024.
Huge growth, 45%.
Marking the highest year on record. Both LP-led and GP-led deals saw significant increases.
Across the board, yeah.
Pricing is also rising. Secondaries pricing as a percentage of net asset value, or NAV, the value of a fund's assets minus liabilities, rose to 89% in 2024, up from 85% in 2023.
Closing the discount gap.
Private debt secondaries saw the biggest jump, from 77% and 91% of NAV.
Wow, near par for private debt stakes. That signifies increasing confidence in the underlying assets.
What about the broader implications?
Looking broader, the performance of secondaries funds has actually outperformed private equity in recent vintages.
Outperformed PE. Interesting.
And offers a strong relative risk-return profile with high median returns and, like private debt, low dispersion. They also offer a stronger liquidity profile. Positive net cash flow for median funds by year 8 compared to year 10 for most other private capital funds.
It's a faster cash back to LPs.
That earlier liquidity is a huge draw for LPs right now.
Then we have GP stakes, a nascent but growing strategy. These funds allow investors to access the long-term economics of the private market industry itself.
Right, investing in the manager, not just the fund.
Rather than just individual funds, it's investing in the business of private markets, essentially buying a piece of the asset manager. What's the appeal for both sides of that equation?
Well, for GPs, it means securing stable capital for strategic growth, maybe M&A, gaining a strategic partner for their firm, and it can help with succession planning, too.
Okay, benefits for the manager. And for LPs?
For LPs, it offers new investment opportunities, an attractive risk-return profile, and direct exposure to the robust, consistent growth of the private markets industry itself.
Betting on the house, in a way?
Kind of, yeah. The report notes that 43% of LPs surveyed already invest in GP stakes funds.
43% are already in.
With 70% of sovereign wealth funds expressing interest in direct stakes. That's significant institutional backing for a relatively new strategy.
And the numbers reflect that interest. Fundraising for GP stakes reached $4.4 billion in 2024, a significant increase from $600 million in 2023.
Big jump in fundraising there, too.
And the number of fund closings hit a record high of 11. Performance shows consistent returns comparable to buyouts, but with far more modest dispersion between top and bottom quartiles.
How modest?
A 7.9% IRR spread for GP stakes versus 13.1% for buyout funds.
Much tighter spread. Highlights a compelling risk-adjusted return. It's a powerful combination of growth and stability.
So we've navigated the complex terrain of private markets in 2024. We've seen an industry in transition, but undeniably resilient and innovative. From the shift away from purely financial engineering to the rise of alternative capital forms and these new strategies like secondaries and GP stakes, It's clear that the old playbook is being rewritten right before our eyes.
It really is. It's a dynamic landscape where adaptation isn't just encouraged, but truly essential for success. It's driving new paradigms of value creation and liquidity.
So what does this all mean for you, listening in? As these markets continue to adapt and redefine what value and liquidity truly mean, what stands out to you as the most impactful shift for your own perspective on finance or investment?
Good question to ponder.
This raises an important question. How might these profound shifts in private capital influence the broader economy and even your own financial decisions in the years to come?